Okay, everyone, we're back. Got a really fun one for everyone today. For everyone who's in Market Hero and has seen the SPX settlement trade, they'll know that that trade is involving selling an iron condor on expiration week, the Thursday before expiration Friday. But when we were doing that over the last couple of years, we saw something that we thought might also be some sort of a profitable strategy. And we did a little bit of research and we found it. So it does look like there's something that goes on with the statistical significance during that week that we think we could definitely take advantage of, and we think we can definitely call it the expiration week setup. So let me explain a little bit about what we're doing here. So for starters, the expiration week setup, okay? Expiration week is the 1 week a month where monthly options expire. So up until about 5 years ago, 6 years ago, options contracts were only available in the monthly expiration. Since then, they've done the weekly options to help people be able to make money in weekly settings or have more short-dated options. But that monthly expiration cycle, that's what we're focusing on here. Okay, so the monthly expiration week ends with expiration Friday, like I mentioned. Okay, which is always the third Friday of every single month. Okay, so forget the weeklies, all that stuff. Expiration Friday, the real expiration Friday, is the third Friday of every single month, thus making that entire week expiration week. So why that's interesting to us is because all hedging for that expiration cycle, okay? All hedging for that expiration cycle from institutions, hedge funds, money managers, all their long stock positions, like hundreds of millions and billions of dollars worth, gets hedged in the S&P 500 in that monthly contract. So all of those hedges expire and settle that Friday morning when all S&P 500 stocks open. So expiration Friday doesn't mean that at 4 p.m. on that Friday that those options actually settle. For the monthly contract, okay, the monthly contract, it is actually as soon as all the S&P 500 stocks open in the morning, which is typically around 9:40, 9:45 a.m. in the morning. And again, all of you who are involved in that settlement trade, that SPX settlement trade, will already know this, all right? So, okay, great. That's nice. Well, what about it? Well, we mentioned that all hedging settles that morning. What exactly does that mean? Because hedging is something that gets very, very confused, very, very lost in translation when it comes to investing. A lot of people do it wrong. Some people do it right. But at the end of the day, hedging gets very, very confused, right? So what it really means is all the hedging that went on, whether good or bad, okay, whether good or bad, it settles directly to cash or has to be unwound that morning. And this is where it becomes interesting for us, okay? So typically, people will hedge their long stock positions, so like a Vanguard or T. Rowe Price or Greenlight Capital. Let's say they're long a couple $100 billion worth of stock. They can't hedge all that stock in those individual stocks. They can't hedge $500 billion worth of of Aaron's furniture. They have to do it in the SPX, right? And typically what they'll do in the SPX is they'll purchase put options. And as you guys know, because you're here with me now, buying puts is a horrible idea. It doesn't even work in the financial crisis. It's a really, really bad idea. However, financial media talks about buying puts. And for some reason, these people that buy puts as a way to hedge their long-term investments, I just don't know. Maybe they just can't help themselves. Okay? So if someone is long a put going into this expiration cycle, which again expires the third Friday of every single month, as soon as all those S&P 500 stocks open for that open that morning. If people all the way until that expiration cycle are long puts, they've bought them, and they need to unwind them, they have to sell those puts back, okay? And selling those puts back obviously is a bullish type of bet. And if you have people who have hedged via buying puts for the entire month, are now selling them back, which is a bullish method, which increases prices, maybe that gives us some sort of a edge in being able to put on a position that benefits from that, okay? Because again, these people are putting on bullish positions because they're unwinding their bearish positions, right? They're unwinding their long puts in favor of shorting puts, right? And that occurs usually towards the second half of the week, all the way up to the actual expiration Friday. So maybe this gives us some sort of an edge or something we could do to make money from that I think might be very, very interesting to everyone. So again, all the while, all these hedge funds, all these institutions are long puts in these monthly expiration that expire the third Friday of every single month. And they're in that because that's the only product that can really have hundreds of billions of dollars go through it at a given time and it'd be no big deal at all. You can't really do that in an individual stock. But because they're long puts, those are bearish bets to hedge against their long stock. But what they have to do, again, is unwind those long puts, those bearish bets in the S&P 500 by selling those puts and creating bullish positions, okay? And they do that usually towards the second half of the week. So maybe that gives us some sort of an edge or some sort of a cushion in doing something. So again, like everything else, we did a study. So we do almost 28 years, over 28 years of data. So 1990 to present in the S&P 500. So the SPX. And I think I got a little bit ahead of myself here, but the SPX, this is where they're hedging in. As you can see here, one of the ways you can tell that it's expiration week is signified by, again, it's the third Friday of every single month. Another way to do that is go into your Analyze tab here on the Thinkorswim platform or any options chain that you have. You'll see here in the SPX there are 3 expiration cycles every single week at a minimum. They're signified here by weekly. The ones that are the monthly expiration cycle are here in white and do not have the weekly notification next to them. So that's the other way you could figure that out. But anyway, 1990 to present, almost 28 years of data in the S&P 500. And what we did was we measured the performance of expiration week in the S&P 500. And again, the reason we did this is because we know for a fact that people are having to put on bullish positions to unwind their bearish S&P 500 positions during that week. So maybe because people are doing that all the time, that gives us some sort of a positive drift for that week. So let's take a look at the numbers. So since 1990, okay, expiration week has been down 42% of the time and has been up 58% of the time. Now, that is definitely something we can look into. Having a 58-42% edge is not really that great. It's probably not as good as I thought it was going to be. It doesn't really scream, hey, this is the setup we should be doing every single time. So because of that, we're going to go a little bit of a step further here. So again, we did 1990 to present in the S&P 500. And what we did was we measured, again, the performance of the S&P 500 during the entire week. And then what we did on top of that is we measured the performance if stocks were down at the beginning of week, Monday or Tuesday, and then the resulting performance, positive or negative, of the week. So the way to think about it is, again, we have high level of confidence that these bearish bets in the S&P 500 as a means to hedge other stock positions by these hedge funds, that getting unwound in the second half of that week. Maybe it's not the whole week that has a little bit of a positive drift. Maybe it's just that second part of the week that has a positive drift. So if Monday and or Tuesday are down, maybe that is a good entry point because we know there is a lot of positive drift going on in the second half of the week. So let's take a look at the results of that. So what you can see here is when the S&P 500 was down on Monday during expiration week, from the close on Monday to the close on Friday, the S&P 500 was up 65% of the time. Okay, that's pretty good. That's really good. Having a 2/3 chance of making money, that is really, really good. That's definitely something we could take advantage of. However, if Monday and Tuesday are down combined, from the close of the day on Tuesday to the close of the day on Friday of expiration week, the S&P 500 is up 76% of the time from that point. So this is kind of the one that we see we have the most amount of edge. And again, we're taking advantage of those bearish bets in the S&P 500 getting unwound by buying those puts back and thus putting on bullish type positions. So again, when the S&P 500 during expiration week is down Monday and Tuesday, okay, from the close on Tuesday to the close on Friday, the S&P 500 is up 76% of the time from that point. That, my friends, is a pretty big edge. Okay, so what are the takeaways here? Well, while expiration week does seem to have a positive drift, okay, due to the unwinding of hedge positions in the S&P 500, we don't see a large enough advantage for just getting long that entire week. Remember, that was only about 58% of the time that the S&P 500 was up for that week. That's an edge, but not a giant edge. We like using big edges. However, our performance is significantly improved when the first part of the week is down, as de-hedging typically occurs closer to expiration, or the second half of the week. And again, really the baby maker here, the big one is when the S&P 500 is down Monday and Tuesday. From the close of the day on Tuesday to the close of the day on Friday, the S&P 500 is up 3 out of 4 times. Again, going back about 28 years, so that's a pretty big sample size. So again, if you want to take advantage of the fact that hedge funds are unwinding their bearish bets and moving them into bullish bets by selling their puts that they're long in the second half of expiration week as a way to not have to deal with settlement issues, they do that very much in the second half of the week, and we could take advantage of that, especially when Monday and Tuesday are down. I'll see you guys in the next video.